Hello, everyone. Welcome to today's event. We'll give everybody a few minutes to join, and then we'll get started. Give maybe one more minute. All right, it looks like the numbers have stopped increasing. Whoops, as I'm learning how to drive. Welcome everybody to today's event. For anybody who doesn't know me, I'm Philip Burris. I'm the chair of the Equine Law section, but not for much longer because the State Bar's fiscal year ends on June the 30th, which means our fiscal year ends on June the 30th, which is why this meeting has been designated as our annual meeting where we're going to nominate some new officers. It's been a thrill and a real honor for me to be the chair for the last 2 years. And we've done a lot of great things, but of course, nobody likes a career politician. So it's time to let some new people take over. In accordance with our bylaws, we established a nominating committee in March. We had a call for nominations in April, and the nominating committee has proposed a slate of officers that includes Lindsay Vance, our current programs chair, as chairperson. Betsy Choder, who has been a member at large, who's kind of been our quasi treasurer until we can get our bylaws updated to have a treasurer, as vice chairperson, and Angela Hinton reprising her role as secretary. And looking at the numbers, I see we have a quorum, and I find the easiest way to do these elections on Zoom is to ask for objections rather than have everybody unmute and vote. So the proposed slate is Lindsay Vance for chair, Betsy Choder for vice chair, and Angela Hinton for secretary. And so I would like to take a moment now to see if there are any objections to adopting that slate as our new officers for the 2022-2023 year. And if you don't want to unmute, you can send me a message, but I'll give just 2 seconds since we do have a quorum. Hearing no objection to the proposed slate, I will take that as adoption of the new slate of officers, and I will congratulate them in their new roles. And as a matter of fact, Lindsay Vance, our soon-to-be chairperson-elect, is the program's chair and is here now, and I'm going to turn the floor over to her.
Thank you, Philip. I appreciate that. I'm excited and look forward to the upcoming year. As for today, in the more short term, I have the distinct pleasure of introducing Mr. Robert C. Webb. Mr. Webb is a member of the Louisville firm of Frost, Brown, Todd, and specializes in civil and criminal tax litigation, white-collar criminal defense, and business litigation. In addition to his distinguished and long-running career as a civil and criminal litigator, Mr. Webb has tried many significant equine cases and controversies, including the defense of a horse breeder in an IRS audit, the defense of an equine breeder in a hobby loss case relating to farming activities, and defending taxpayers from around the country in equine-related IRS audits related to passive activity losses, at-risk limitations, and Code 162 deductions. Mr. Webb is currently representing clients in 2 active hobby loss actions, one involving quarter horses and the other involving the breeding and racing of thoroughbreds. Mr. Webb is a graduate of the University of Kentucky, the University of Louisville Louis D. Brandeis School of Law, and Georgetown University Law School, where he earned an LLM in taxation. If you have questions during the presentation, please feel free to unmute yourself and ask them, or pop your question into the chat box where he will see it and respond. We are thrilled to have Mr. Webb present to us today on a topic with which he has so much experience. Without further ado, Mr. Bob Webb.
Thank you, Lindsay. Thank you very much. Thank you all for attending, all the attendees who were on board. These hobby loss cases can turn into big dollars pretty quickly, and it's hard on the equine industry and really the farming industry because these cases can come up with cattle, alpacas, thoroughbreds, quarter horses, reining horses, pleasure horses, and I've had cases from all of those fields over the last 30 years, and they can be big dollar cases because you're looking at, they're going back 2 to 3 years, and then you typically have the future years to worry about. Are you going to stay in the business or not? Or are you going to try to wind it down to stop the losses? Is a decision that most taxpayers who are in litigation have to make. Because if the IRS, once you get on the IRS radar screen, I can't tell you how many times I've had a hobby loss case, we settle it in appeals, and then 2 to 3 years later, they come back on us for a second time. So it's a repeat audit that once you get on the IRS radar screen, it's not as easy to get off. So the hobby loss rules we're going to talk about in some detail today. Really, let's go to the first slide there, Phil. What the hobby loss rules really do is they prevent a taxpayer from using deductions from your horse business to offset income that's earned from other for-profit activities. So, the classic fact pattern is, a wealthy, high net worth individual who's very heavily involved in some type of horse operation, whether that's racing, breeding, or, just speculation. But it's typically high net worth people, not always high net worth, but those are the bigger cases, are the ones who are generally have large amounts of income from other sources that they're using the losses from the horse operation to reduce their overall tax liability. So that's really what the hobby loss rules do. We can go to the next slide. So what is a hobby? It's an activity that is not engaged in for profit. It's really carried on as a sport, hobby, or for recreation. And as we'll see when we get into the factors of the way the IRS looks at this, what we're going to do, we're going to look at the IRS factors that are statutory in the Internal Revenue Code that really determine whether an activity is a hobby or not. And then we're going to walk in to act just like we were being audited, and we're going to go through some document requests that the Internal Revenue Service agent will send out. And then they'll typically request to interview the taxpayer. And we're going to go through some actual questions that I've been asked many times over the years by IRS agents. For those of you who really don't practice in the tax controversy area, what typically happens in these cases is you have someone from examination, the auditor, come out, conduct the exam, and then typically you will disagree with the report because if they determine it's a hobby. And then you will go to the IRS Appeals Division, where 90% of the cases get resolved and settled based on the hazards of litigation. So that's where most cases are resolved. If you can't reach a settlement with the IRS Appeals, then you go to the U.S. Tax Court most of the time and litigate before a United States Tax Court judge. So let's go to the next slide. Now, the activity, in order to avoid these hobby loss rules and these hobby loss limitations, have to be engaged in for profit. So what does for profit mean? Even though if you read the cases, you can come away with the believing that it's really a subjective test based on the intention of the taxpayer. Does the taxpayer intend in his own mind to make a profit with this activity? Now, the way that you determine intent, which is not easy to determine, you can't cut someone's head open and look in their brain. So the IRS and Congress has come up with this idea that you'll look at objective factors and other facts and circumstances to determine the subjective intent of the taxpayer. So we're going to spend some time going through the factors in Code Section 183 and just break down what this for-profit means. We can go to the next slide. Now, Internal Revenue Code Section 183, not to drop code on you, but that is really where the action is in the hobby loss area, because that is where you'll have the limitation on your ability to make deductions from your horse activity against other income that you may be earning from other businesses. Okay, we can go to the next one. So hobby loss defined. losses from business activities not undertaken with a bona fide intention of earning a profit. There's that subjective test that I was talking about a few moments ago. It is a subjective test, but the government uses objective factors to review your state of mind and your true intent. And I will say, although we're only going to discuss the Section 183 factors today, there was a case that came out a few years ago which allows taxpayers to introduce other factors that might not be outlined in 183 if they're relevant to the issue of the taxpayer's subjective intent as to profitability. Okay, next slide. So I think I've already mentioned this a couple times, but it's really the sort of the backbone of what we're going to talk about today. We're going to look at these objective standards and all the facts and circumstances surrounding the farming operation or the breeding or the racing operation, and try to determine how the IRS views these horse activities. Next slide. This is interesting to me, that a reasonable expectation of profit is not required, but the taxpayer must demonstrate an objective of making a profit. So everything that we're talking about today is really focusing on, the lens is really focused on, is this business, this horse activity, trying to make money, or is it just being done for personal pleasure or other reasons, rather than a profit motive? So that's the real heart and soul of the hobby loss area is, are we trying to make money? And if so, how do we prove that to the Internal Revenue Service? Next slide. Now, a small chance of making a large profit may be enough to avoid the hobby loss limitations. So this comes up in some of the thoroughbred breeding and racing operations, because as all of you know, if you happen to breed or buy the Kentucky Derby winner, you've got basically a stud fee annuity for years to come. So you do have a substantial opportunity to make a large profit. So even if your chances aren't good, if you have the ability to make a large profit, that's a good factor in your favor. Next slide. So I mentioned this a little earlier, but it merits mentioning again, that the tax court and the judges are going to give more credence to the objective factors that we're going to talk about today, rather than the testimony of the taxpayer. Tax court judges are skeptical of testimony who comes from taxpayers who know there might be millions of dollars or hundreds of thousands of dollars at stake. So, in all our cases, you're going to have the owner of the operation testify under oath that he's trying to make a profit and explain why and how he's trying to make a profit. But it still comes back to these objective factors that we're getting ready to discuss. Next slide. So the first factor under Section 183 is the manner in which the taxpayer carries on the activity. So this is, you can just think of this like any business, is the horse activity being run in a business-like manner? Now, what does that mean? Well, do they have books and records? Do they do quarterly profit and losses so that they can track the activity and the profitability or the amount of losses on a regular basis? So you want to make sure, if you're involved in a horse activity or your clients are involved in a horse activity, that they really do conduct it in a business-like manner with complete, accurate books and records, etc. Okay, next slide. So here's just some examples of what we would show the Internal Revenue Service to demonstrate that we are trying to make a profit. If we've been unprofitable and had losses for many years, have we abandoned some of our old methods and have we adopted new techniques to try to make a profit? That's a good way to demonstrate that you're trying to make a profit. I'm in a substantial quarter horse hobby loss case right now where they were breeding pleasure horses for years and years, And then they hired a farm manager who came in and decided, well, we need to move into the reining horses because there's actually larger purses and more money to be made on the stud fees and the reining. So they're in a transition stage right now of moving out of pleasure horses into reining horses. That's a concrete example of how you're adopting a new technique and abandoning an unprofitable method. You want to have your clients have a written business plan. So just like you would, for any business, you want budgets and projections, separate bank account, separate entity. And it always helps if you're in the business of selling horses or breeding, you want to make sure that you advertise your business and advertise your horses, and you want to track all that and keep it good records of what you've done to try to, improve your business and improve your profitability. Next slide. Now, the second factor is the expertise of the taxpayer or his advisors, which is an important because, I had a client in the thoroughbred industry who got into the racing and the breeding, and he was a medical doctor, but he took a lot of time and engaged in extensive study of the equine business and the equine horses. And he really went out and talked to people. He kept records of who he talked to learn the business. He really studied the medical side of the horses and the breeding. And we ended up getting him actually a very good resolution in IRS appeals because he had really put in the time and the effort to become an expert in his own right, in the breeding. And he had some very successful horses that he had bred, and he did all the selection himself. And he had other consultants that he would consult with. But the point is he didn't just hire somebody and turn it over to them and then have a lot of losses. He was involved in the day-to-day buying and selling and the decision-making of what medical procedures to do on a horse and other factors. So you wanted, and again, everything, you'll hear me repeat this throughout, but you need to track and keep a diary of everything you did to learn the business, everything you did to teach yourself and anybody that you consulted with to try to help you become an expert in whatever horse activity that you're engaged in. So the expertise of the taxpayer is a very important factor that you want to make sure you document extensively. Next slide. Now, how do you develop your expertise and relying on your advisors? Like I mentioned, you can learn the medical procedures. All horses have medical problems, especially in the thoroughbred industry. There's a lot of medical procedures that are typically needed. And if you receive expert advice, you have to follow that advice. So if you're getting consultants to, give you tips and advice on how to run your business and how to become more profitable, you need to document that advice and you need to try to make sure that you follow it. Next slide. Now, the third factor is the time and effort expended by the taxpayer in carrying on the activity. So this is really how many days a week and how many hours in the month is someone spending on this activity? Because if you're not spending any time on the activity, it really and you're just showing up at the horse shows or the horse races, and you're really not doing anything else other than attending events, that's not a very good indication that you're spending the required time and effort to demonstrate that you're really trying to make a profit. So, and you want to document the time and effort that you spend. We'll talk a little bit at the end about the material participation rules, but if you don't materially participate, then all of your losses from the horse activity will become passive, and you won't be able to offset your ordinary income from the passive losses. So you want to make sure that you track very thoroughly how much time and effort you put into the business, not only for this factor, but for the passive activity loss factor as well. Next slide. So I just mentioned some of this, so I got a little ahead of myself, but you want to maintain receipts for all the expenses. I mentioned the material participation logs, and devoting a limited amount of time to the activity, like I mentioned, you still have to be involved with your advisors, even if you have people running the business and horse managers managing the business. You still need to be involved with that decision making and considering the advice that they're giving you. And you want to document all of this. So I know this sounds like an onerous thing, but if you're ever audited by the Internal Revenue Service, or you ever have to go to the United States Tax Court, original documents that were prepared at the time that the activity was being conducted are the most valuable evidence in a tax court trial. I get in cases sometimes where people and lawyers and CPAs will prepare business plans, after the fact, or go back and try to reconstruct material participation logs. That type of evidence simply doesn't carry the weight that a contemporaneously created document does. So you want to document it as you go. Next slide. So factor number 4 is the expectation that the assets used in the activity may appreciate in value. So this term profit that we talked about earlier does encompass appreciation in the value of assets. And this could be important if you bought a farm and you're raising horses on a farm, or you have a breeding operation on a farm, because the appreciation of the land can actually be factored in to this issue of profit. Obviously, if you're going to believe that the horses that you acquire are going to appreciate in value, so you want to make sure that you're at least thinking about what your expected appreciation in value is. Next slide. So again, you're going to pick up a theme here. You want to track and document the fair market value of your assets as you go along, and track the increased value that these horses acquire, through their good works over the years, and as well as the land. An appraisal of the land is not a bad idea either, at least periodically. So you've documented the appreciation that you're factoring in to the business analysis, the overall profitability. Okay, next slide. Factor number 5 is the success of the taxpayer in carrying on other similar or dissimilar activities. So, if you have a successful businessman who has taken businesses that weren't profitable and made them profitable, this can be a good factor because it demonstrates that this individual may have the ability to actually turn this horse breeding operation into a profitable business. Now, I've been in several cases, this is principally with high net worth clients, where the IRS tries to flip this on you. So, I have one client who was audited in the horse industry, and we had to go to the tax court, and he was making millions and millions of dollars a year from his operating business that he ran on a daily basis, and he was losing millions on the horse operation. And even though he was so successful in his other business, the IRS kept coming back to, if he's so successful in the other business, why is he so unsuccessful in the horse business? It doesn't, their point was, it doesn't make logical sense that he would be so successful in one industry and then in the next business have, loss after loss after loss for years and years. So they can try to flip this one on you if you're not careful. But you have to highlight any success that your taxpayer has in other businesses to try to at least hold your own in this factor. Okay, next slide. Now, it really helps if the activity is similar to the horse activity that you're trying to say, drawing a comparison to. So the closer you can bring the business into something similar to horse breeding, racing, etc., the stronger your success rate is going to be under this factor. Okay, next slide. The taxpayer's history, factor number 6 of income or losses with respect to the activity. Now, I've got a note here that a series of losses during the initial or startup stage doesn't necessarily mean that you're not engaged in for profit, but this may be the most important factor in the eyes of the Internal Revenue Service agents and the IRS lawyers. You know, if you have cases where you've had 10, 20 years of multi-million-dollar losses, you know, just year after year after year, and you've never made a profit, those are challenging cases. Not that we can't win some of those cases, but this factor, in my experience over the last 30 years, is one that the IRS, and I think the reason the IRS really gravitates to this factor is it's pretty simple. You know, the numbers don't lie. Either you made money for the last 10 years or you lost money for the last 10 years. So it's a pretty simple argument that the government can make if you have a string of continued losses. So this is, in my opinion and experience, probably the most important factor in the eyes of the Internal Revenue Service. Okay, next slide. So if you do have losses, and especially if you have recurring losses, you again want to document the unforeseen circumstances that cause those losses, or you know, make sure you track the depressed market conditions. You know, during COVID, a lot of my thoroughbred clients, you know, really had a hard time because there was no sales. You know, they couldn't travel to Australia, they couldn't travel globally. So the equine business really took a pretty major hit. And that'll be very useful in a hobby loss case because it's an unforeseen circumstance. There's depressed market conditions. And those are the types of things that, you know, I've had economists as experts come in and actually testify as to how bad the industry or the market was in a given year and why. So that's an important reason. If you do have a lot of losses, document those losses. Next slide. The amount of occasional profits. Again, this is an important factor, similar to the loss factor we looked at a moment ago. But if you do have profits, they're going to look at how much of those profits in a ratio basis compared to the losses and how much money does the taxpayer have invested and the value of the assets invested. You know, with a breeding operation, one of the most difficult things to overcome is there's so much capital investment. There's barns and training facilities, and it costs a lot of money just to get set up to start breeding. And then you have the depreciation on all of those high capital costs, and it can really make it difficult to make a profit for tax purposes simply because of the depreciation. So the amount of the investment is going to be important. Next factor, next slide. So how do you demonstrate your opportunity for a substantial profit? If it's highly speculative, like buying racehorses off the track, you know, trying to get that Kentucky Derby winner, that is definitely a speculative potential high return. And I always use the analogy, it's like a wildcat investor drilling oil wells. You know, he may miss 10 oil wells, but if he hits the big gusher, then all the other prior investment was well worth it. So you can sort of use that analogy in some situations if you're dealing in high dollar horses. And a high dollar horse can mean different things to different people, you know, so that's just something to keep in mind. Next slide. This is also a very important factor, the financial status of the taxpayer. You know, if the taxpayer doesn't have a lot of extra income and he's generating most of his revenue from this horse activity, you know, that's a much better fact pattern than the individual I mentioned earlier who's making millions of dollars from a separate business and losing millions of dollars in a horse business. So, you know, if it can be a substantial operation and substantial investments, but if you're dealing with a high net worth taxpayer, it can be difficult for the Internal Revenue Service to accept that he's trying to make a profit, because they simply say, even though these losses are very large, it's not impacting his standard of living. So he can afford the losses. And that's a factor that the IRS loves to throw back at you if you're dealing with a high net worth taxpayer in the horse industry. Next factor, next slide. Yeah, I've got a note here. I think I've already covered this. Really, wealthy taxpayers who enjoy horse activities and incur losses will rarely win factor 8 because of their financial status. So I think I've covered that. Next slide. This last section 183 factor is the elements of personal pleasure or recreation. So the government, the IRS, agents and lawyers are going to be trying to determine, is there a personal motive for carrying on this activity rather than just a profit motive? You know, does the taxpayer have grandchildren or children that ride the horses and show the horses? So he goes and watches them show. You know, the IRS will throw that back at you as, look, you're really doing this for the kids. This has nothing to do with profit. You know, you're getting a lot of personal pleasure out of the activity, watching your children and grandchildren ride. So that's something you have to be wary of, you know, if you're in the planning phase of trying to plan to avoid these hobby loss rules. Next slide. Now, personal pleasure, it's not fatal to your case, and we've overcome this many times over the years. So it's not that you can't have fun and enjoy what you're doing. You know, you don't have to hate what you're doing. You know, we've had this comes up oftentimes in hobby loss cases, because typically there will be family members involved. And so the IRS is going to make the old argument, you know, again, you're doing this because of your family and to spend time with your family. You know, I had one hobby loss case that was very substantial that had continuous losses, and the taxpayer's son was actually doing the buying and selling of all the horses for him. And unfortunately, he wasn't doing a very good job. He was losing money every year. And the IRS pointed that out at every turn all through the case, that, you know, and this was a high net worth taxpayer, that the main reason that he was doing this was to give his son something to do and to interact and spend time with his son. So you have to watch this personal pleasure factor. Next slide. Now, we've gone through the factors in the Internal Revenue Code that, you know, you need to look at and review if you have a taxpayer starting an equine business. Now we're going to talk about what type of records, if you are audited, will the Internal Revenue Service examiner ask for. They typically, in an IRS audit, will send out something called an information document request, requesting a host of documents. So they typically will ask for the original accounting records and books. You know, they're going to want to see, and this really goes back to what this really is getting at is are they running it in a business-like manner? That factor that we talked about earlier. You know, do they keep cash receipts journal? Do they have invoices and sales journals? Do they track their business expenses? You know, do they keep check registers? Is everything documented? You know, the cost of goods sold on the horses, you want to make sure you do a great job of tracking and maintaining what you paid for the horse, what you spent on the horse, and try to do it on a horse by horse basis, and what the eventual sale price of the horse was, because that way you're tracking your cost of goods sold. Okay, next slide. Other documents they're going to request are for the expenses. They're going to ask for we want a separate entity, so they're going to ask for the original corporate charters, any loan documents or loan applications that you applied for. They're going to want to review those. because they want to know what you're telling the bank in your projections to get a loan. I'm sorry about that. I mentioned this already. They're going to want a list of your horses, and they're going to want to make sure that you're studying the horses and the cost of the horses and the experience you had with each specific horse. So it's very important to track it on a horse by horse basis. You know, get you an Excel spreadsheet or something like that where you can actually track horse by horse and track the related expenses incurred with a specific horse. Next slide. So, you know, I've mentioned this already, but it's very important. If you have a client starting any type of horse business for profit, they need a business plan. They need it to be written down in stone, you know, how they're going to make money and have some type of, you know, financial projections and budgets that support the plan and the goal. And, you know, again, if you're breeding, you want to track each foal and through its present disposition and track it on a horse by horse basis. Next slide. Now, those are some of the documents that you can bet the Internal Revenue Service will ask for if a horse activity is ever audited. Now, here are some actual interview questions where we've been asked these questions by Internal Revenue Service agents or lawyers about these factors. So if you'll remember back to our first factor, the manner in which the taxpayer carries on the activity, they're going to want to know when and how the idea for the business activity originated. You know, did it come from really a profit motive, or did it come because, you know, little Johnny really likes the horse business and likes to ride and show horses? You know, they're going to look at they're going to want to know what the financial requirements were to start the business. Did you have to get a loan, or are you funding this out of, you know, funds earned from other businesses? So the financing of the business is very important if you're borrowing money to run the business, because that demonstrates that, you know, there really may not be a surplus of cash from other sources to offset the loss, you know, to carry these losses from the horse business. Next slide. Now, the expertise of the taxpayer or his advisors, you know, what background information was gathered about this type of activity prior to beginning the business? You know, had they ever been employed in this area before? You know, did they grow up on a farm? You know, did their mom and dad have horses? Have they been around farming? You know, these are important factors with respect to the expertise that if they have that history, you're going to want to highlight that to the Internal Revenue Service. So it's very important what experience they've received regarding the horse business and, you know, any other horse related activities. So, you know, I mentioned this earlier, like the life experiences of the taxpayer are very important. You know, was he around horses? Did his father take him to the racetrack as a child? You know, did they spend time around horses? So those are personal reasons, and it can also go to the expertise of the taxpayer. The other thing you're going to want to make sure that you do if you're trying to make money in the horse business is you want to get involved in all the associations and all the organizations for your specific breed of horse. And if you hold a leadership role in those organizations, that's a great factor to demonstrate to the Internal Revenue Service that you have not only the expertise, but you have the confidence of your peers also who trust you to take a leadership role in the organization. Next slide. The time and effort expended by carrying on the activity. Okay, for the taxpayer, is this something he does on the weekends, or is this something he's out there doing every day? So the IRS is always going to ask, you know, who runs the day-to-day business operations, you know, of the horse activity. And then the more involved your taxpayer is with the activity and the business, the better off you are and the better case you have to defend your activity from the hobby loss rules. Next slide. Again, these are mirroring back to the factors that we talked about earlier on the factor that the expectation of assets will appreciate. You know, the IRS will ask, well, is it likely that they're going to appreciate? You know, why does the taxpayer expect appreciation to occur? And again, this gets back to a potential appraisal. You know, at what rate are the assets expected to appreciate? You know, how many years is it going to take to hit these appreciation numbers that could be substantial in terms of analyzing the profitability of your horse activity? Next slide. The success of the taxpayer in other or similar dissimilar activities. What other activities has the taxpayer had previous success with? You know, again, we talked about this earlier, but they will ask the questions about what other businesses the taxpayer has been involved in. Has he done any turnarounds? Has he taken unprofitable businesses and made them profitable? So this is a question that you'll definitely be asked. Your taxpayer will be asked. So next slide. These questions go to the taxpayer's history of income or losses. You know, and this is a key question right here. You know, what is the taxpayer's explanation for continuing with an unprofitable activity? That's a question that you will always be asked by the revenue agents and the IRS lawyers if you have a long series of losses. You know, what's motivating the taxpayer to continue to lose millions of dollars a year on this horse activity? You know, did he, and we talked about this earlier, but again, if you adopt new techniques or abandon unprofitable methods, you want to document those changes contemporaneously with when you make the change. So, you know, the key question though that you're going to be asked is, you know, what motivates the taxpayer to continue losing money year after year after year in this activity? Next slide. The amount of occasional profits which are earned. You know, again, they're gonna ask what investment has the taxpayer made. And, you know, as I mentioned earlier, in the breeding operations, you know, this can be a hard one to overcome because there's so much capital investment required to set up a breeding operation in a farm. So they're going to look at that. They're going to look at the operation and the scale and scope of the operation. And even if it's substantial, you know, if you're dealing with a high net worth client who can afford it, you know, the IRS is not going to be that impressed just because you have first class operations and breeding. If you're still losing money and you have sources from income sources, you know, from other activities where it really doesn't hurt you at all to lose. In other words, you can afford to absorb the losses because of your separate income is a factor that they're going to look at in a big way. Okay, next slide. The financial status of the taxpayer, they're going to ask you, you know, what tax benefit does the taxpayer receive from the losses on the activity? They're going to want to know if he can afford it, you know, even though it has continued losses. And this gets back to that factor that we were talking about earlier, the financial status of the taxpayer. Probably one of the most important issues is just how wealthy and how much disposable income does your client have? Because if they're incurring, you know, a large amount of losses, but they have so much income from other activities that it really doesn't affect their standard of living, then those are difficult cases to get. Those are cases that you normally have to take to tax court to win because it's difficult to get good settlement in appeals. Next slide. Elements of personal pleasure or recreation. Again, we've talked a little bit about this. You know, how did the taxpayer get involved or interested in this business is a question that they're always going to ask you. And they're going to also ask, you know, are there members of the taxpayer's family that are involved in the business? The IRS loves to bring this up and just try to beat you over the head with it because, you know, they can say, aha, you know, this has nothing to do with profitability. This is all about, you know, little Susie riding horses and showing horses, and you're funding it even though you're losing money. So that's a very important factor that the IRS will always throw up to you. Next slide. Now, there is a presumption for profit if your gross income exceeds your deductions from your horse activity in 2 of 7 years for breeding, training, showing, or racing of horses. You know, then you have a presumption of profitability. So, you know, as part of your business plan, if you can figure out how to just make money a couple years, then you can actually achieve this presumption that can be very important. Next slide. Now, here's the bad news is if you do get audited and they determine that you've been deducting hobby losses against ordinary income, they're probably going to hit you with some penalties. So one penalty is they're going to be accuracy, we call them accuracy related penalties. It's 20% penalty for negligence or disregard of the rules. And these penalties can become very substantial if you're dealing with like 3 years of losses. And when you start stacking that up and hitting it with a 20% penalty, the numbers can get large pretty quickly. Next slide. So what is negligence? Any failure to make a reasonable attempt to comply with the Internal Revenue Code. What would an ordinarily prudent person do under the same circumstances? So it's sort of a subjective analysis. You know, were you negligent? But they'll typically, if they determine that it's a hobby, they'll typically always hit you with a negligence penalty. So that's just something you have to be on the lookout for. Next slide. The other accuracy related penalty is the disregard of the rules or regulations. So if the IRS believes that you were careless or reckless, or that you intentionally disregarded the rules, you know, then they're going to hit you with this penalty, another accuracy related penalty. So you have to be careful to avoid these penalties. And the more you've documented your activities to show you're really trying to make a profit, the easier it is to prove what's called reasonable cause to get out of the penalties. So that's your best defense to get out of these penalties. Next slide. So what is reasonable cause? Well, is there reasonable cause for the underpayment? Did the taxpayer act in good faith? Or, you know, are the facts just so clear that this was not a business, that this was just a hobby that was being written off against other ordinary income, the losses? So but there is penalty relief if you can qualify under the reasonable cause defense. Next slide. So what is reasonable cause? It's ordinary care and business prudence. And this is a facts and circumstances test, similar to the actual analysis involved in the actual, you know, 183 factors themselves that we've been talking about. Next slide. So a lot of people try to get reasonable cause by relying on their tax advisor. You know, well, you know, I had a CPA who was preparing my return, and I relied on the CPA to make sure that I was doing everything right. And that can work, you know, if all the facts and circumstances were disclosed to the CPA and he had full knowledge of the business, but he can't, you know, make unreasonable factual assumptions about the appreciation of horses or your farm. Everything has to be reasonable. Next slide. So now this is a topic we could spend a whole hour on, but I'm not going to do that. But I just want to highlight it to you because it is important and it does come up in a lot of horse cases. You know, you must materially participate in the activity or you can't deduct your losses against active ordinary income. And this means that you must be involved in the activity on a regular, continuous, and substantial basis. Now, what does that mean? Okay, next slide. There's basically 7 material participation tests, which I'm not going to read all 7 of them to you. I think we're sort of closing in on our time anyway, and I do want to save a few minutes for questions. But if the individual participates in the activity for more than 500 hours, then it's active. That's clear. That's not an easy burden. It's not an easy goal to reach. But if you document, like my medical doctor did a good job of documenting all of his reading, and I had one client in the thoroughbred case who tried to say that watching Seabiscuit qualified for material participation. So we had a little problem coming up with the hours necessary in that case because they watched a lot of horse movies. But let's go to, I don't want to just read these to you. Let's go to the next slide. Yes, 7. Back one. Yeah. The 7th factor that the 7th test is, based on all the facts and circumstances, does the individual participate in the activity on a regular, continuous, and substantial basis during the year? That's the key. And again, these material participation logs need to be maintained contemporaneously with the activities. So if you don't keep a material participation log and you go back and have to reconstruct a material participation log, it's just not going to have the weight of evidence that one that was originally maintained would have. Okay, next slide. So if you're looking at a horse activity or someone is bringing a horse activity for you to look at, what are some of the I call it sort of a pre-audit analysis that you want to go through with your client? Are there activities with large expenses and little or no income? Again, a long series of losses, not a good fact. Are losses offsetting other income on the return? Clearly that's the goal of the hobby loss, is to prevent that. So if that's happening, then you have a potential audit candidate. Does the activity result in a large tax benefit? Again, if the losses are offsetting ordinary income to a large degree, that could be a flag for an IRS examination and IRS audit. So you want to watch these factors. And we've talked about this, but again, I think this is probably, at least maybe not to the judges, but in terms of IRS personnel, the most important issue is, is there a history that shows any profit in any years, or has there just been loss after loss after loss? So I think that concludes my presentation. If anyone has any questions, I'd be happy to discuss anything anybody wants to talk about.
Hey, Bob, I've got a couple. So these pre-audit analyses, I guess they're primarily taken from a tax return. This is where, these are the flags that trigger these hobby loss audits? Yes.
Yeah. When a tax return gets filed, it gets scored. It's something called the diff score. And it's like golf. The higher points, the more points you get on the score, the higher you are to be an audit candidate. So if you've got a horse activity that's really just reducing taxes from other businesses substantially, the IRS, we don't know this because we don't know exactly what the diff score does, but I'm pretty confident that they have ratios where they're running ratio analysis on these tax returns. And if they see ratio that looks at, if they see a Schedule F loss, for $1 million and you see $2 million of income, I think that's a ratio that creates a red flag.
That makes sense. And does the IRS have any metrics on kind of what their success rate is if a hobby loss audit is initiated? How often does the IRS prevail?
I've never looked into that. As I mentioned earlier, most of these cases, now there are a fair amount of cases that have been litigated. I've litigated several hobby loss cases over the years, but most of them, if you find a reasonable appeals officer, the IRS appeals office, they settle the case based on the hazards of litigation. So they're going to be looking at, if we do go to court, what is the probability that we're going to win, or what is the probability that we're going to lose? And so if you do a good job in the appeals division, you know, you can generally get a pretty good deal from the appeals officer if you put together a good case for trial. And sometimes what I'll do, if I have a client like my medical doctor that really knows the horse business and really did have a plan, it's just he lost a whole lot of money, you know, executing the plan. I will actually, in the appeals conference, I'll put the taxpayer on the phone or bring him to the appeals conference and have him tell the IRS a story that he's going to tell on the witness stand. So give them a firsthand look at what exactly is going on here and what the taxpayer is going to testify about. So that's something that I found to be, if you have a good taxpayer with a good story to tell, that's something that can really be effective in getting these cases settled in appeals, so you don't have to go to litigation.
Interesting. Are there any other questions? If anybody has a question, you can feel free to unmute, or if you want to send it to me in the chat, I'd be happy to ask it, and we'll give just a second to see if anybody has any questions. Not seeing any. I really want to thank you, Bob, for taking the time to talk to our section. This has been an incredible presentation and has given me a lot of food for thought, for sure. And I appreciate you taking time out of your vacation to do it. We're very honored to have you, and we really can't thank you enough for being here.
I'm happy to do it. I love hobby loss cases, so it's really not a burden. I can talk about hobby loss cases all day. So if any of you ever have a question or find yourself in an audit, feel free to call me and we'll talk it through.
That's fantastic. Well, thank you again. Thanks to everyone for attending. I appreciate you coming today, and congratulations to our new officers. And we will see you at the commencement of our next year, which starts Friday. Thanks, and have a great day, everybody. Lane, I think we're done.
This concludes today's meeting. Thank you for joining. Have a great afternoon.
Bye, everyone.
Bye.